marketing. So we're starting off with market structure. So your structure should look something like this. It doesn't have to look 100% similar to mine, but you want to use the right ideas. So this is a low, high, low, high, low. A couple of things about this is these here, you don't start marking up these highs and lows. This is wrong, right? You want to follow it. So low, high, high. This high broke the previous low, right? So this now becomes the new low. Then we had the high, right? Then we had the low. Now, the reason why I've gone all the way back is because this links onto last week, Wednesday's trade, right? So now we have this high over here. So when I looked at Wednesday's trade last week and Thursday's trade, right? What was really happening, if I go back to Wednesday, let's start with Wednesday. So on Wednesday, this was market open right here. So there was market open, or no, sorry, that wasn't market open, but you get the point. Market open was there. So basically, what was going on with market structure was that we had marked it out, and basically my bet was this. This was my bet. My bet was that this was going to be a local high. Now, the reason why, I want you to try and imagine this as well. The reason why is because we had this. We had a low, high, low, high. Now, when it comes to marking our structure, one thing you want to understand and one thing you want to open your eyes to, this is going to look really basic, but there's a lot of power in keeping it basic, right? What you've seen here is this, right? What you've seen here is this. You've seen here. You've seen low, you've seen pullback high. Then you've seen low, then you've seen a high. Now, in order for you to then count on some kind of pullback, you have to be above the previous high like this. Does that make sense? So you want to be selling above old highs. That's what the SOH stands for. Selling above, old highs. I've messed that up. Hopefully you can see what I'm trying to say. Do both of you see that? Give me a yes. Someone give me a yes.
Yes.
Yeah, so that's what we're focusing on there. So this was basically the whole idea of Wednesday's trade, right? This is basically how I spotted the level. So if I go back to Wednesday, I started off by, I always post this, right? I'm going to start posting it in school as well. I always post this because this is how I want you to think, right? Now, so this is now Wednesday. Let's go to last week, Wednesday 8th. So if we go to the 8th, there we go. So I've kind of explained the same thing here. So we had a structure high, structure low, structure high. So my guess was after we've gone through the structure, the next thing is the dealing range, right? Or we look at what we call targeted liquidity. That's kind of step 2. Targeted, let me spell that right. Targeted liquidity. So think of it at the top. So I'm going to write the acronym at the top for both of you to understand. So it's going to be S.T.E.P. like this. So first we do structure, second we do targeted liquidity. Now what we mean by targeted liquidity, very, very simple, is this. This is what we mean. So targeted liquidity is basically targeting on 2 specific areas. You're looking at the most recent low and you're looking at the most recent high, right? That's why we call it targeted liquidity, because there's liquidity below every low and above every high. I call it targeted liquidity. That's the T in STEP, right? Because we're only looking at this high and more importantly, this low. Does that make sense? Right? So you want to look at the most recent high and low. I call it targeted liquidity 1, so it fits nicely in the acronym. And 2, because you're specifically focusing your attention on the most recent high and low. Okay, good. Now, step 3 is we look for equilibrium. Now, what do we mean by equilibrium? So I'm just going to write EQ for short. So what you want to do is you want to project your fib from your high to your low. So I don't really like to call it fib because I know fib has like so many other strategies ingrained into it. But really, a fib is the most recent low up to the most recent high, just like this. Now, the power of using the fib is that it gives you the power of drawing that equilibrium down here. Hopefully you can see that 50% is the equilibrium. Just from self-explanatory, you should be able to see that anything above the 50% is your premium, anything below is the discount. Yeah. Now from there, you then want to identify and ask yourself, I mean, on Wednesday, were we in premium or discount? Well, anyone can see we're in pretty high premium, right? So that was the first thing. And then the final thing we look for is a price imbalance, right? Price imbalance, otherwise known as a fair value gap. I prefer to call it price imbalance because just sounds more professional, and I like to keep it nice and simple so you can remember. Just remember the 4-step process. So just remember STEP, S-T-E-P, right? So structure, targeted liquidity, EQ, and price imbalance. The mistake I see, or the problem I see a lot of traders make, is that they will try to find a price imbalance without actually going through the first 3 steps, which is wrong. You want to go through the first 3 steps first. Very important. Now, once you've done that, this is the reason why Wednesday's trade, I think, was really good. And this is the reason why Thursday's trade ended up really good. But let's just focus on Wednesday first. If we go to Wednesday over here, here we go. So this was the key level I had. So notice how there's a price imbalance there. Can both of you see that? Price imbalance right there.
Yes.
Yeah? Now, the bet that I was making was that Wednesday was going to create some kind of pullback. Now, why was Wednesday going to create some kind of pullback? So this is where it becomes a little bit discretionary, but I don't like using the word discretionary. It comes from pattern recognition. So I think, James, you probably saw this. I did post it in the Discord. There we go. So hopefully you noticed. So 1st of April, high of the week was on Wednesday. Okay. And even I think it was the final week of March, if I'm not mistaken. Yeah, final week of March, so like the 24th of March, whatever it was, 24th of March, high of the week, Wednesday, melted, right? 1st of April again, right? We had a meltdown. So both of these Wednesdays, we melted. So when I got to last week on Wednesday, I kind of betted the same thing, right? The other thing, which I don't speak about as much, but I need to, the weekly opening price. Now, Isaiah, I'm going to ask you a question. This is for Isaiah, right? When we're above the weekly opening price, do we look for longs or shorts?
I'm thinking that I guess it depends if you think that trend's going to continue, if you're mean reversion oriented. But I would imagine you'd only be looking for long entries because it's already above weekly open.
Yeah, so it's actually the opposite. So typically what we're doing is with other areas of the strategy, right? When price is above the weekly opening price, we typically look for, I say typically, it's a confirmation to go short. Now the reason why is because of this, right? Because let me get this weekly opening candle up. So this is the weekly opening price. Now what you will find typically when you do a little bit of back testing, I'll give you some additional homework you can go and try, right? If this is the weekly opening price, right, what you'll find is that the best shorts or the best short trades typically will happen somewhere inside of this wick. Now, of course, you need a key level, you need absorption, you need to have this 4-step positioning process, you have to have a good read on price. This is just a confluence. I don't want you going away thinking, oh, we're above the weekly opening price, let's short. No, that's not how it works. We use the
now. Is this candle the current week, or is it the candle representing the previous week?
So you can notice here the candle is moving in real time, right? So if you look at this, can you see how it's moving? It's changing shape.
Oh, so yes.
It's in real time. So the bet I made was I followed the 4-step positioning process, which is what I started with. I then started identifying the last few Wednesdays. This is Wednesday the 8th, Wednesday the 1st, Wednesday the 25th, and I think the previous Wednesday did something. There you go. Even the previous Wednesday did something, right? Notice how we had the melt off on Wednesday, melt off on Wednesday, melt off on Wednesday. That was how last week's trade and level was formed, right? Melt off on Wednesday. So tomorrow's Wednesday. Now, I'm not saying we're going to see shorts, but do you see how we're beginning to build patterns here? Hopefully you can start to see that, right? Now, I'm not saying tomorrow we go short. Of course not, right? But I'm just saying, if we do, then I was right. But you see what I'm saying? Hopefully we're trying to build some patterns here. Now, once you've done that, let's now go to the actual. So here's where the order flow really kicks in. So this is our level. So the level doesn't take that long to find. We want to now focus on the price action inside of that level. So here, here, and here. Now, I'm gonna throw it. I'm just gonna, before we go into the actual order flow, I'm gonna break down the framework or how you want to be looking at this strategically. Now, we use something called the real-time reading blueprint. Now, the real-time reading blueprint basically tells you want to be reading the bid and ask, evaluating the delta, assessing aggression, and detecting zeros. This is the order in which you want to be analyzing price. So think about, okay, bid and ask. So read the bid and ask, evaluate the delta, assess aggression, and detect zeros. So we are now going to apply that same framework to the charts, right? If there's one thing you take away from this call, it's you want to be thinking in terms of frameworks. So I've built alliterative acronyms, or these fancy names, just to stick into your brain. So think about the 4-step positioning process, right? The real-time reading blueprint. And the word read means a lot to us because we're reading the bid and ask, we're evaluating the delta, we're assessing aggression, we're detecting zeros. I apologize. I repeat that unapologetically so that it can be delved into your thinking. So now from here, let's just go into the order flow. So bid and ask, right? Now I'm going. This is mainly for Isaiah because I know you might be Isaiah. You might be new to order flow, right?
Yeah, I mean, I'm trying to make my way through
Yep.
the classroom videos, but I
Yep.
don't think I've gotten to this yet. I know you've made some references to delta, but I don't fully understand this chart or this concept yet.
Okay, done. Let's change that in the next 5 minutes. So basically, can you see? I know the numbers are very. I know the numbers are quite blurry, but can you appreciate how there's a left number and a right number?
Yeah. Yes.
Can you also appreciate that the left number is called the bid, or the right number is called the ask? Don't worry, in the school there are classrooms on this. This is like I think when you read this, when you go to this classroom, they'll be like, oh yeah, I remember that. Well, I remember what Sandy was saying. Now, the bid and the ask is fundamentally how every market works, right? Now, it's fundamentally the orders we need to understand. Now, what you want to understand with the footprint chart, I say, is that it typically works with any strategy once you have a system down. But what you want to understand is that the bid represents the aggressive sellers, and the ask represents aggressive buyers, or market sellers on the left and market buyers on the right. I'll repeat that one more time. The bid is the aggressive sellers and the ask is the aggressive buyers. Now, why is this important? So that's the R. So we're reading the bid and ask. What did the E stand for? I say specifically. What did the E stand for?
Evaluate the data.
Delta.
Delta. Okay.
Delta. So what we mean by delta, again, there are classes on this, so take your time with it. But delta is basically the right number minus the left number. So it's the market buy orders minus the market sell orders. Does that make sense?
Mm-hmm. Yeah. Now I have a quick question.
Yeah, please.
The number on the left, does that mean the total amount sold at that level?
Okay, think of it like this. So on the footprint charts, there are market orders that you see. So think of it this way, right? So can you see how if you go to the left, it says, let's just say it's 68.35. It's probably like 36 or something, but let's just say 68.35 for round numbers, right? Can you see that?
Yes.
Now, what that means is at that price, right? At that price, we can see a lot of blue delta. So to answer your question, think of them as you have sell contracts on the left and buy contracts on the right. You can literally, so the way I remember when I was like 22 or 3 in my early 20s when I got into this, I used to literally think of it as humans fighting, right? So the left number represents sellers, the aggressive sellers, right? So the market sellers. So in real time, this is why this in the process, in the premium footprint process, this is why we call it the real time reading blueprint, not just the reading blueprint, the real time reading blueprint, because the most important time frame is the now time frame. And what you want to understand is that, to answer your question, the left number is the bid. These are the total number of contracts at that time. So this is probably off the top of my head, I can't remember the exact time, but this was maybe 9 a.m. Eastern, right? So at 9 a.m. Eastern, at that time, at this price, 68.35, let's just say, I know the numbers are blurry, but let's just say it says 128 over here. There were 128 market sellers that were actively trying to drive price down. Market sellers want to drive price down. Does that make sense?
Yes. Yeah, that's actually helpful to kind of break that down, because the fact that it's blue is a little counterintuitive to me, that you're saying that they're sell contracts, but the way you just explained it is helpful.
Welcome to order flow. So basically it's by 11, right? It's absolute gold dust, this stuff. The first 5 to 15 minutes is where most traders trip up, because they try to trade the price action instead of reading it and getting a sound understanding. And how do we read the price action? I was so obsessed with it, I made an acronym on it, right? So this is what you want to do. I'm going to go through that one more time, because James, what you said was very good. So basically, there was so many, think of them as people, little people, right? They're trying to push price above this level, but we broke significantly below it. So it shows you at this level, between sort of 68.37 and 68.27, there was a huge ton of buyers that were absorbed, as James said. So who's really in control at this level? And it's not just this candle, it's also here, 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 and here. Hopefully you can see here. What's super fascinating is that this is a red candle. Can you see that? if you look very closely at the top, there's actually a pretty strong blue delta there. This is what's super powerful, and these are things you're going to pick up the more you look at footprint charts and order flow. You're going to be able to look at certain candles and say, wow, that's a red candle, but there was a huge buyer inside that red candle. What's that buyer doing there? Was that buyer successful? Well, not really, because we didn't break above the level. So price is showing me lower price. So the market's showing me lower prices with red candles, despite there being lots of buyers in that region. Oh wow! So that means there must be a seller there. If there's a seller there, I better be selling. You know what I'm saying? So this is the kind of frameworks that I've had in my head for years. I just wanted to finally get it out using acronyms. I think acronyms is a good way to remember it. Does that make sense?
It does. Thanks.
So now this is what's even more important. I'm going to show you why these levels are very important, because I get asked this question so much. How do you find your key levels? Now, the truth is it does take practice. This is why I've actually dedicated an entire session just to finding levels, because levels is a lot more than just people will never appreciate it. I mean, you two appreciate it. That's why you're here, right? But most people never appreciate that finding levels is finding levels or finding key levels is an art form that follows systematic framework. So in other words, your levels might be slightly different to mine. Like I have a mentor in the US, right? Carmine Risotto. I don't know if both of you have heard of him. Fantastic order flow trader. Check him out. His levels are similar to mine, but they're different. What I mean is his ones are like typically tighter. He'll enter with tighter stop losses. I prefer wider stop losses. That's just my style. But if you look at his levels, they're somewhat similar to mine, but he finds them the same way, but they're somewhat different. So your levels don't have to be exactly identical to mine. However, you should be able to back up your levels. You should have confidence in your levels. And one thing I learned from my mentor Carmine was trust your levels, right? TOL, trust. So TYL, sorry, trust your levels, right? Super, super important. I'm going to show you I'm really passionate about this one because I get lots of questions on it, and two, it truly changed my trading for me. It stopped me from FOMOing and getting into bad trades, and I felt comfortable being patient. And I'm going to show you how this was. James, do you remember last week Thursday? Remember that trade we went through last week on Thursday? James, are you there?
Yes.
He's gone. Yeah.
Yeah, I've put myself on mute, but
That's
yeah,
you don't have to put yourself on mute. There's only two of you. You can butt in and speak when you want. It's fine. So now from here, what we'll do? Let's go to yeah. So this was obviously I won't go through the actual setup itself because that's not really the purpose of this call. But let's go through Thursday's trade. So we're still on the 4-step positioning process. Now from here, what I want you to understand. So we're going into Thursday. This is now Thursday, the 9th of April. Now from here, what you want to understand is this, right? So if there's one thing you take away, and I'm going to get my framework up again, and I make no apologies about repeating this every single day, because this is how I trade. This is the premium footprint execution process. So did you see on Wednesday we had a good trade? We had a precision entry. Can you see that here? So what that means is precision entries give us confirmation that that is actually a key level. So when I ask traders, how do you find your key levels? I look for them to take me through this process of, I used this process to find the imbalance. I read price in the imbalance. Price showed me trapped sellers. Then I took this execution, and therefore that confirmed that it was an area of supply. That means that sellers and buyers were sitting there respectively, and therefore I am positioning my next trade off that key level. So I want to see them go on this journey. I call it the journey of 4 Ps, right? Positioning, price, proof, and precision. That's the execution. That's the premium footprint execution process. So now that you have that, right, what you want to understand is that this is the key thing to take away from this lesson. This was Wednesday's setup where I've circled. Can you see that? Can both of you see that? I want both of you to say yes. This was Wednesday's setup, yeah?
Yep.
Yes.
Now, it's not a coincidence that Thursday's setup came here. That's not a coincidence. That's not some weird coincidence. That's not like the Matrix, right? That's basically how markets work. Markets gravitate towards, I mean, my one of my mentors, Carmine, said this, right? I'm just going to steal it from him. Check him out. He basically said that the market gravitates to where the most pain, he said something like the market goes to where the most pain has happened, or the market will gravitate towards where the most pain has happened. What I mean by that specifically is that there was pain here, right? Trapped buyers, I'll go through trapped in another session, right? But basically this was the execution. So they were trapped buyers here. So this is what created the level, right? This is what created the level. So it's all right. No, don't worry, James, it's fine. So it's not a coincidence that price came back to this level. This is not a coincidence. Now, I promise you, once you see this, you'll feel like you're in the matrix. You'll be like, oh my gosh, like this is crazy. It's not a coincidence we had that level. So James, if you remember last week on Thursday when we were going through this live in the Discord, what I was trying to say to you was, if you remember me, I got so bored I started going on Canva and making these fancy little things. So this was me at 10:25 Eastern, right? I started like labeling random things, not trading, just looking. Now, Now we tapped into this level at 16:35 UK time, which corresponds to 11:35 Eastern. So not long to go. So basically, we had yesterday's high and we tapped into that level. So this level was the exact same as Wednesday's level. This one here. Hopefully, you both can see that.
Yes.
This is the power of levels. This was the reason. This is why I call it the 4-step positioning process on school, because I wanted this to be the lesson. So now that you've done that, the execution we follow a different execution protocol. We call it the bolt breakout blueprint. I won't go into that. But basically, what you saw on Thursday, you saw the aggressive sellers failing. Then we went long, right? So the long trade looks something like this, right? So here, it's the exact same thing. It's just flipped in reverse. So if there's one thing you take away from this entire session, it's understanding the power of choosing the right level with the right processes, and then having faith in those levels in the next 1, 2, 3, 4, 5 days, because price will come back to there if you've chosen them correctly. That's what I wanted to go through. That was the entire message for today. And I think James caught a piece of that move as it was happening towards the top. Very good, very good level that. And so just to finish off, because it's like 1:23 in the UK AM. So just to finish off, let's just do this. So what do I think is going to happen tomorrow? Well, tomorrow is Wednesday, right? So tomorrow's Wednesday. I mean, last week we broke that Wednesday. So Wednesday we had somewhat of a melt off, and then Friday we had the melt off, right? Let's see what tomorrow does, right? So Wednesday, in the last few Wednesdays, we've been having somewhat of a dip down, right? So we've been having somewhat of a dip down, right? Wednesday, dip down. Wednesday, dip down. These are all Wednesdays, yeah? These are all Wednesdays. So let's see what happens tomorrow. I don't want to force shorts because I think we're going to see an all-time high. I hope we get back to an all-time high. I really hope we do. And yeah, so that's it. These are sort of my levels from today. I mean, we really just raced up. These are my levels from today, right? Maybe as an exercise, James, you can go back, screenshot this in your own time, and go and see why these are levels using the trap framework we discussed. Yeah. But hopefully, I'm going to stop the recording now. Hopefully, you both of you